The amateur dreams of constant action. This is the quickest path to ruin. They believe opportunity is a fire hose they must drink from constantly. Yet the true law of scarcity dictates the market's greatest wealth is reserved for the perfect, rare trade. Real profit does not come from high frequency, but from concentrated power. A handful of perfect setups that align structural advantage with psychological certainty. You must understand that volume and sheer activity are the enemy of quality. You must accept a fundamental, painful truth about the market. Over 95% of its movement is just meaningless noise, a cacophony designed to lure the undisciplined into unnecessary action. This persistent, grinding noise should be ignored completely, treated as static on a broken radio, not data to be acted upon. Your primary task is not to find a trade, but to sit in silence until the noise gives way to an undeniable signal. Trading noise is the surest way to guarantee capital attrition. Your trading frequency must become the inverse function of your trading quality. Every moment spent sitting still, every day you do not execute a trade, serves as an exponential filter, raising the quality of the few trades you ultimately take. The less you trade, the more rigorous your selection process becomes, and the more impactful each perfectly chosen trade will be upon your equity curve. The machine gunner exhausts his ammunition and exposes his position. The sniper waits for the perfect single shot. I demand you define your waiting setup with such unforgiving precision that it can appear at most only one time per week. This setup is your personal, unique fingerprint. It is a convergence of signals so specific that when it appears, you know instantly and without hesitation that the market is offering you the highest available probability. This level of specificity is the barrier that prevents the erosion of your patience and capital. It eliminates all marginal setups and leaves only the prime opportunities. The speculator's highest priority action is always capital preservation, and this must be enforced through a policy of extreme, uncompromising patience. You are not waiting for the market to move. You are waiting for the market to move exactly to your predefined high-probability trap. This waiting is not a passive activity. It is the most demanding psychological labor you will ever perform, the ultimate act of discipline that ensures your survival. Waiting is the highest form of risk management. Every potential setup must be judged against the unyielding law of context. A seemingly perfect entry on a shorter time frame is nothing but a trap if it is counter to the dominant structural positioning visible on the weekly or monthly charts. Context is the map of the campaign. Without it, any entry is merely a reckless skirmish. The setup must confirm the larger existing trend and the major support or resistance zones that define the true character of the market movement. Never confuse a tactical opportunity with a strategic one. You must establish a mandatory minimum risk-to-reward ratio. For me, it is never less than 1-to-5. That automatically filters out every single mediocre opportunity the market presents. The moment you consider a trade that does not offer a vastly disproportionate reward for the risk assumed, you are gambling, not speculating. This ratio is your core operating law, designed to ensure that even with a modest win rate, your financial progress remains exponential and robust. It means rejecting 9 acceptable setups to secure the one that is truly exceptional. Your entire preparation must begin with a comprehensive monthly mapping process designed to identify and chart the 3 highest probability confluence zones for the upcoming 30 days. These zones are points on the chart where price action, volume analysis, and time-based cycles align with overwhelming structural evidence. You're not searching for these zones. You are creating a fixed schedule for when the market is permitted to offer you a trade. Everything outside of these 3 pre-mapped zones is dismissed as distraction. Before a single dollar is risked, the waiting setup must involve a minimum of 3 distinct quantifiable criteria aligning simultaneously, forming an undeniable pattern of market readiness. This 3-point check is the final, unbreachable defense against impulse trading. It must be a specific price level, a specific volume signature, and a specific structural confirmation, all converging at the same moment. If only 2 criteria are met, the setup is invalid. You close the screen and wait for the next alignment. The amateur believes they must jump aboard a moving train, chasing the momentum and paying an ever-increasing price for the illusion of action. The disciplined speculator knows that you never chase a move. The entry rule must be based purely on price returning back to a predefined specific level of value. If the market runs away before tagging your entry, you treat it as a missed opportunity that was not yours to begin with, refusing to compromise your entry price. You wait for the market to pay you a premium for your patience. Following any trade execution, regardless of whether it results in a devastating loss or a significant profit, I mandate an automatic full day of rest. This is not a suggestion. It is a critical psychological firewall. A loss triggers the destructive desire for revenge trading, while a win breeds the equally destructive overconfidence that leads to excessive risk-taking. You must deliberately remove yourself from the screen to reset your mental equilibrium. Your mind, not your capital, is the asset you must preserve immediately after a market event. The endless stream of economic news releases and corporate announcements is primarily designed to create volatility and confuse the mass of emotional traders. You must ignore all of it unless and only unless a news event is scheduled to coincide directly with one of your pre-existing high-probability confluence zones. The news then acts merely as a catalyst for a pre-established technical judgment, never as the primary reason for entry. Price action always precedes the headline. I commit to a maximum limit of 4 trades per calendar month. This is a hard, non-negotiable constraint that enforces the scarcity principle. Once the 4th trade is initiated, regardless of the P and L outcome, all trading must immediately cease for the remainder of that 30-day period. This strict limitation compels maximum due diligence on every single entry, forcing you to prioritize only the finest setups. It is the ultimate discipline to sit and watch a perfect setup pass by because you have already fulfilled your allocation. The highest form of speculative discipline is the internal strength required to sit perfectly still on your hands when the setup criteria are partially met, but not fully satisfied. I once saw a zone that met 2 of my 3 necessary criteria, and the pressure to enter was immense. The price was perfect, the volume almost there, but the structural confirmation was missing. Had I entered, the immediate reversal would have taken my entire allotted risk for the month in a single emotional mistake. I sat and watched the market burn the emotional traders who took the partial bait. The market has one objective: to inflict the maximum pain on the maximum number of participants. A partial setup is its preferred psychological weapon. It offers just enough incentive to draw the weak in, only to destroy their capital when the 3rd missing criterion reverses the move. The discipline of the full rule is what separates the winner from the crowd. The temptation to just take a small piece is the market's subtle invitation to your own destruction. You must predefine the precise profit target and the catastrophic stop-loss using objective structural levels before the trade is triggered, accepting no mid-trade adjustments. The moment the trade is live, it must be treated as a purely mechanical event, free from the human weakness of hope or fear. Moving a stop-loss is an act of cowardice. Adjusting a target is an act of greed. Both violate the foundational plan and invalidate the setup's original probabilistic edge. When a meticulously planned setup appears and then runs away without tagging your entry or fulfilling the criteria, you must treat that missed setup with the same cold, quiet equanimity as you would a profitable one. Opportunity cost is merely a psychological fiction invented by the losing trader, and it is entirely irrelevant to objective risk management. Your concern is only with the integrity of your process, not with the money you did not make. The market will offer another high-quality chance next week. The retail crowd spends 80% of its time on execution, fiddling with order sizes and indicators, and only 20% on anticipation and planning. The professional speculator completely reverses this focus. I spend 80% of my time in quiet anticipation, marking my levels, reading the larger market context, and preparing the trade plan. The execution itself is reduced to a purely mechanical, 20% action. Victory is won in the planning room long before the bell rings. The ultimate filter is your own physical and emotional state. If a perfect setup appears but you are tired, stressed, preoccupied with external life events, or mentally compromised, the setup is instantly invalidated and must be skipped. You cannot bring a chaotic mind to a disciplined game. The quality of your judgment is paramount. The market is unforgiving of lapses in mental focus. If you are not operating at 100% psychological capacity, your edge is temporarily removed and you must step away. Because the focus is solely on the 4 highest quality opportunities, you allocate maximum appropriate risk, never more than 2% of total capital, only to these selected setups. You must never spread this risk across multiple low-grade wishful thinking entries. Concentration of capital on high conviction. Structurally sound opportunities is the only way to generate exceptional returns. Low conviction trades deserve zero risk. I demand the maintenance of a trade log of rejection, a detailed record documenting all the times you intentionally chose not to trade a mediocre opportunity. This log is the counterintuitive evidence of your self-control and the foundation of your future discipline. Reviewing this log reinforces the immense value of patience, demonstrating tangibly how often inaction preserved your capital and prevented disaster. You must celebrate the decision to reject an entry as a psychological victory. A single perfectly executed great trade, the culmination of days of preparation and waiting, provides more psychological and financial benefit than 10 mediocre, rushed, and stressful trades combined. The great trade confirms your process and reinforces the habit of patience, which is the most valuable asset you own. The mediocre trade, even if profitable, erodes your discipline and teaches you the wrong lessons. You must stop measuring success based on daily, weekly, or monthly P&L fluctuations. The true measure of a master is the adherence rate to the 4 trades per month constraint and the fidelity to the full 3 criteria setup rule. The P&L is merely the outcome of the process. The process itself is the only thing within your control. Success is discipline. Profit is the reward discipline grants. Simplicity is the final, most sophisticated layer of optimization in any trading method. You must ruthlessly remove any indicator, variable, or external news item that does not directly and quantifiably contribute to the core 3 criteria of your waiting setup. The complex setup is an admission of doubt. The simple setup is the expression of certainty and clarity. Strip away the noise until only the signal remains. The market does not pay you to trade. It pays you to wait with absolute conviction for the perfect confluence of factors. Impatience is the hidden commission fee, the heavy tax levied upon the disorganized, emotional, and undisciplined speculator. Embrace the waiting setup philosophy. You must train yourself to trade like a sniper, a hunter who observes for days, not a machine gunner who sprays hope across the charts. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical, it is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.